Welcome to NTD Business. I'm Don Ma. A couple of things to talk about today. S&P 500 is now in a bull market. It's up 20% from its lowest point in October. Now, this matches the definition of a bull market, and the most commonly accepted definition is a 20% rise off a low for a bull market. Goldman Sachs has now joined the growing list of market strategists who are increasing their year-end S&P 500 targets. So now, why has the market rallied? Now, this is partly because the economy did not fall into a recession, not just yet, despite some predictions. Markets tumbled last year on fears about how the worst inflation in decades would ravage the economy. A number of indicators pointed to a recession. For example, yield curve inversions. Wall Street was also spooked by the aggressive hikes by the Federal Reserve. Many investors were bracing for a recession. But a remarkably resilient job market, among other things, has kept the economy afloat. But now inflation has eased off since hitting a peak last summer. Wall Street is now hoping for the Fed to soon stop hiking interest rates. So along the S&P, the Dow and the Nasdaq are already in bull markets, having entered them in November and May, respectively. But despite the S&P 500 being in a bull market, there are still a number of indicators pointing to signs of weakness in the economy. U.S. manufacturing contracted for a seventh straight month in May, and new orders continued to plummet, for example. Banks have also tightened lending after the recent financial market turmoil. But here's the thing, the market sometimes just does their own thing despite certain economic data. So most of the gains for the S&P 500 this year have come from just a small group of stocks. Apple, Microsoft, and Alphabet, the companies with the highest market values in the S&P 500, all outpaced the index. Their huge size gives their movements extra weight on the index, while nearly half the stocks in the index have dropped so far in 2023. Critics are also questioning whether this rally is sustainable. But to point out, this is not something we haven't seen before, and narrow markets can, in fact, last a long time. And here to talk to me is Lauren Sprung, Midland Financial. Now, the S&P 500 being in a bull market, I think it achieved this a few days ago. With all the talks of a recession, this dating back to last year, I mean, what's driving this? Is this strange to you?
It's not strange at all, actually. There's a lot of evidence to support what we've been seeing over the last several months. And, going back, looking at the last 13 bear markets, most of them from the time we hit the bottom, which sometimes it's hard to tell what the bottom is. But for this, bear market that we were in, the bottom was October 12th. So right now, rallying off that bottom is not an uncommon thing. Typically in the last 13 bear markets, we've only retraced and backed down to those lows on two of those occasions. And those two occasions are during the financial crisis and the tech bust in the late 90s, which, it was very difficult to be in stocks then. So this is not uncommon. It actually is more common than not.
But I do see a dichotomy, if you will, between some economic indicators and what the market is feeling. For example, manufacturing, I think that has been in a recession, although the jobs market is pretty strong. So, I mean, there's a lot of leading economic indicators suggesting slower economic conditions. Although that's not 100% guaranteed. But despite that, markets are rallying. Can you comment a little bit on that?
I think the reason why we're seeing the markets rally now is we're entering a period of time where we're at the end of interest rate hikes. And I think looking back 2, 3, 4, 5, 6 months ago, people were really not sure how long these rate hikes were going to continue. I think we're pretty close to the end. We maybe have one more hike coming in July. And I think the market is anticipating that those are coming to an end. The economic indicators are showing that things are doing well. If you look at the earnings numbers, things have started to rally since the last earnings report. And I think that the expectation is we're going to see something similar come Q2 reports.
Now, here's another question: is the S&P, in a healthy state, right? Because there's only a handful of stocks moving the market now, so the breadth is very narrow. So when it's rallying, is it just those few stocks at the top that's rallying?
It depends on the day. A good portion of what we've seen of the rally thus far this year has come from those, few names that are out there for sure. But remember also, many of those names we're talking about that's leading the S&P today are many of the names that took a bigger hit than most of the other names during the downturn last year. So, it would make sense that those that got beaten up a little bit more than maybe some of the others would rally a little bit more quickly. So, again, from an investor standpoint, right, the S&P 500 is a great gauge about what's going on maybe in a general sense of things. But as far as an investor is concerned, that's why you have to pay attention to a diversified portfolio. You want to make sure that your portfolio is benchmarked to a reasonable benchmark. Most people don't just invest in the S&P 500, which I think is very important to remember.
Right. I understand what you're saying, but let's say if your portfolio is diversified and only a few stocks are moving the market, I mean, aren't you at more risk of losing?
Listen, there can be. I mean, if it also depends on what percentage of your overall portfolio is allocated to those very few securities, right? Most people who are investing for long term don't have a tremendous concentration in 1, 2, or 3, or 5 securities. It's usually pretty diversified. So, if you were just in those 3 securities, I agree with you, Don. I think you have to take pause and maybe rethink your strategy there because of the rally that's taken place. Does that continue? I don't know. But if you have a diversified portfolio, remember, those names were the names that probably hindered you last year, and now they're helping you this year. So it's all about, having that long-term time horizon and being able to continue through your portfolio through different market cycles.
I mean, how should we feel about this rally within the S&P 500? Are recession talks behind us now? Is no recession?
Well, I mean, I will tell you this, myself and those at Carson Group who we're a part of have been saying for, since the beginning, since going back to October of last year, that recession may be unlikely. I know there's been a lot of talk about it, but, we've had the stance that we don't know if a recession is even going to happen. If it does, we think that it's not going to be, anything that's going to be major impactful. Remember, when we started hearing a lot about recession, the big impetus was that we were hearing about a lot of layoffs. And the reality was, if you looked at where those layoffs were taking place, they were taking place in those same names we're talking about now, right? Who also went on a hiring spree at the beginning of the pandemic. And the reality is their headcount today is still higher than where it was at the beginning of the pandemic. So it was really just releasing and lowering headcount based upon the conditions that exist today. So I'm not convinced that we're going to have a recession. And if we are, it's probably not coming in the near term.
Well, here's the problem from the Fed's perspective. It needs to lower inflation. It needs higher unemployment, a slower economy. It needs to have the consumer stop spending, and it can't do that when consumers have jobs. So, in a sense, it needs a slowdown in the economy for inflation to come down. So, I think this is the dilemma right now. Where are we going?
Yeah, I mean, listen, that is definitely one of the major issues that the Fed is facing today. But remember, one of the major impetuses for our decline last year, if you remember, was the tremendously high inflationary data that was coming in, which basically put us in that situation where the Fed aggressively started raising interest rates, right? And that added some skepticism to the viability of what was going to happen in the markets over the coming months. Now we're in a situation where inflation is coming down, right? Maybe not exactly at the target, but also let's keep in mind, we're only about a year into this interest rate hiking cycle. So some of that effect hasn't even filtered through the entire system. So I think it's going to, have to be, maybe there's one more hike, and then there has to be a little bit of a wait and see approach to see how this all filters through. Because listen, you don't want to go tightening even further in anticipation of things staying where they are. You have to let things that they put into motion work as well and see what the outcomes are.
So just one final thing then, I guess. What are some of your tips to investors right now, seeing what's happening?
Yeah, I mean, listen, we've been in constant contact with the families that we serve throughout this whole process. Starting with October of 2021, we started reducing, longevity on bonds in anticipation of rate hikes taking place in 2022. I think us, like many others, didn't expect them to go up as quickly as they did. But the reality is, most of the families we serve, they're not traders, so they don't need to worry about the day-to-day. The whole idea is, let's put together a diversified portfolio, and then as these market events unfold, make minor adjustments that hopefully will lead to major improvements in the long run. So we're not wholeheartedly selling a whole position or buying. We're looking at the market as a whole, their portfolio as a whole, and where we are in relation to what their personal goals and objectives are. So every family is different. I can't say that we're doing this for everyone, because I don't think it works that way. So, we have to take that under advice and guidance. We take what's going on in the macro world and we apply that to the families that we serve.
All right. Thank you so much today, Lawrence. Always a pleasure speaking to you.
Same, Don. Have a great day.
In other news in the financial world, billionaire investor George Soros is giving control of his $25 billion empire to a younger son, Alexander Soros. This is according to an exclusive interview with the Wall Street Journal published online Sunday. The 37-year-old told the Wall Street Journal that he's more political than his father. George Soros has been a right-wing target for years now for his backing of liberal causes. Alexander Soros noted that he and his father think alike. Alex said he was broadening his father's liberal aims and embracing different causes, including voting and abortion rights, as well as gender equity. He said he aims to keep using the family's wealth to back left-leaning U.S. politicians. Alex told the Wall Street Journal that he recently met with Biden administration officials, Senate Majority Leader Chuck Schumer, heads of state, and Canada's Prime Minister Justin Trudeau to push for issues related to the family donation. During the interview with the newspaper, Alex expressed concern that former President Donald Trump would return to the White House and hinted that the Soros organization would play a key financial role in the 2024 presidential race. Now, this recent appointment passes over George Soros' elder son, Jonathan Soros, 52, a lawyer with a background in finance. He had been believed to be the clear successor until a falling out and a change of heart, according to the paper. And meanwhile, Americans' expectations for inflation a year from now fell to the lowest level in 2 years. This is according to a New York Fed report on Monday. The May survey of consumer expectations report said that respondents project inflation a year from now to hit 4.1%. Now, this is down from 4.4% in April. The survey found respondents expecting lower food, rent, medical, and college costs over the next year. The New York Fed survey also found that respondents were a touch more gloomy about prospects for borrowing money. It said respondents' views about future credit availability deteriorated slightly, adding that the share of respondents expecting tighter credit conditions a year from now increased, while the share expecting looser credit conditions declined. The survey also found households forecasting modestly better earnings and a small rise in projected future spending. Meanwhile, the survey showed fewer respondents expect the unemployment rate to be higher a year from now, which is a good thing. And the probability of losing one's job over the next year was seen at the lowest level since April 2022.